Ladies and gentlemen, welcome to another Independent Speculator interview. Our guest today, it's a little bit different from what we've been doing for some time. So this isn't going to be an in-the-pit grilling, but this is more of a conversation between hopefully interesting minds. Our guest is Danielle DiMartino Booth. She's a former Fed insider, and she's been splashing about the airwaves quite a bit. You may have seen her appearing on lots of the financial media, talking about what the Fed is doing and why and what the consequences are. This all has a lot to do with our investments, so I thought it would be interesting to talk to Danielle in a little bit more than the 3 minutes snippets we usually see on Yahoo Finance or CNBC. So Danielle, why don't you tell us what you're doing and why, and then we'll get into what's going on in the world and what we can learn from it.
Sure. So I started off at a firm called Donaldson, Lufkin and Jenrette, and then we were bought up by Credit Suisse in New York. So my background was always the markets and finance. And when I left Wall Street and moved to Dallas, I ended up somehow, some way landing in this great big bureaucracy called the Federal Reserve. And mainly because the gentleman who I was working for, Richard Fisher, was like me, an MBA in finance, who also had started off in New York on Wall Street. So I ended up becoming his advisor throughout the financial crisis years for 9 years, learned a lot about how monetary policy directly affects the markets, corporations, households, governments, how they operate, what the decision-making framework is, depending on where monetary policy is positioned. And after I followed Richard Fisher into retirement in 2015, I started a research firm. We now have Quill Intelligence that offers a daily as well as a weekly institutional deep dive, and it is a follow-on, if you will, from the book that I wrote when I left the Fed called Fed Up, which really tried to explain to everyday investors, students, anybody who's interested, what monetary policy actually is without couching it in jargon that makes absolutely no sense to anybody but the people inside the Federal Reserve.
Okay, well that's great. It's a great overview, and I really do want to get to your insights on what the Fed is doing now, because we've seen it really rock the market one way or the other so much. But before we go there, if a free promo here, tell me a little bit more about Quill Intelligence. What is it that people get when they sign up for that? Why should people read what you're writing?
Well, what we do is the same thing that I did when I wrote Fed Up. I didn't have an agenda. I'm not necessarily in the school of Keynesians or Ricardians. I'm simply somebody who would like to convey what is going on in the economy in the most simple terms possible. And Quill Intelligence was founded based on that. We like to refer to Wayne Gretzky as our hero. We try and tell investors where the puck is headed. We are self-proclaimed cycle chasers, and we try and look to the most leading economic indicators as well as those in the stock market to tell investors where the economy is in the cycle, and most importantly, where it is headed, so that you can position your portfolio accordingly. So we've got a cult following. It's been a great first year. We launched the day after Memorial Day 2018, and the Daily Feather, which is our daily offering, is really something that retail investors can get their arms around and gain an appreciation for a very reasonable rate about where we are at the intersection of monetary policy, the stock market, the bond market, and economic data.
That's really interesting. It's kind of funny. We launched almost a year ago as well, so we are co-buddies on anniversary dates there.
There you go. Happy anniversary.
Thank you. You too. So one last thing on that. You're economists. You're looking at the economy. You're giving investors intel, hopefully, on where the puck will be in the economy. Do you also try to forecast what the Fed will do?
Oh, that goes without saying. So I would never waste my experience inside the Fed. In a million years, like I said, I never thought I would be a bureaucrat, but my understanding of how the Fed operates is something that is integral to the research process at Quill Intelligence. Absolutely.
Okay, well that makes perfect sense. All right, so let's move into that then, if you will. Mm-hmm. And the thing that really strikes me right now in our current context is the way President Trump, who was anti-easy money before as candidate Trump, now as President Trump, he's all in favor of easy money.
Imagine that.
But Trump aside, he's actually tweeted in favor of what to me looks very much like a call for more QE, and not just end the tightening, but the opposite, which would mean more QE. And I'm a free market economics type. You know, I like the Austrian school, so I'm not in favor of this. But I have to ask, you know, CPI remains low. You know, you have these new modern monetary theorists saying, you know, why don't we just, you know, pay for everything? You know, so what is the argument against that? Why shouldn't Trump get what he's asking for with the economy seeming so strong and, again, inflation rates seeming so low? Why not print money to pay for this stuff?
Well, and that's a good question, and it's very difficult to combat with modern monetary theorists because of what QE has exemplified in the past. To the extent that the Fed is not capable of unwinding quantitative easing, of completing the process of shrinking its balance sheet, to the extent that they cannot do that, it is standing proof that in practice, not in theory, money printing works because you've effectively monetized away the debt, as frightening as that sounds. And that is what I think a few, adept, savvy observers in politics have concluded from the experience of QE. It was interesting to hear Powell push back recently in congressional testimony and say that he didn't believe that unfettered money printing to infinity was actually feasible. Ask anybody in Beijing if they want for us to go that route. I'm sure they would say yes, because at some point you do put your currency at risk if you just keep piling on the debt as if it's never going to have a consequence. But to your question about Donald Trump, if you think back to Barack Obama's re-election campaign, we're talking about early November, the election. October the 13th, quantitative easing 3, QE Infinity, was launched 6 weeks prior to the election. You don't have to be a political historian to say that that's, these types of things, give it away for free, keep the stock market up, let's see new highs, go baby, go. These are the things that get people reelected. So Trump is just being a political animal, which we know that he is, and saying that if it was good for the prior administration to have the money printing presses going at full bore, then why isn't it good for me? And his closest advisors, Larry Kudlow, Steve Mnuchin, they're wise enough about Fed policy to say, well, first you've got to stop shrinking the balance sheet, which Rich Clarida, the vice chairman of the Federal Reserve Board, has told us will happen by September. And after that, you've got to get rates back down to the zero bound, which involves a series of rate cuts. And not until then can you theoretically launch quantitative easing. But that is exactly what Trump is trying to line up in time for November 2020.
Okay, so not blaming the political animal for being what he is. And again, I don't approve of this, but what is the economic argument?
Any patriot would not approve of this.
Right.
I'm just spelling out the thinking.
Right. So what is the economic argument against it? I mean, what can we say to the MMT crowd right now besides, oh, in theory, this is bad, or we don't want to end up like, the Weimar hyperinflation or something like that, and by the time you're too far down the slippery slope, it's too far. I mean, these arguments fall on deaf ears. Is there anything that we can tell them now besides point to history to say, look, this is a really bad idea?
Well, you have to bear in mind that the world is not purely economic. I think that the theory that we have expunged hot wars from the discourse is probably naive on the part of people looking forward, saying there's never going to be another war. And the reason I bring that up, it's not hyperbole, it's because that tends to be how reserve currency status is lost. And it's because it's nothing that a country would stand for willingly. The United States is never going to say, strip me of my dollar reserve currency status. Tell me that I have to turn the printing press off, because that is effectively what it does. But again, the risk is that the Chinese, who have been showing up at Treasury auctions, it's not that they've pulled back. They're still the largest holder of U.S. Treasuries, but they have been strategically reducing the duration, reducing the maturity of their U.S. Treasury holdings as a factor of time. That tells you that they want more financial flexibility when we emerge from whatever the next downturn is. The business cycle has not been eradicated. Hail to von Mises himself. It cannot be eradicated. But the Chinese are positioning themselves to where, if they decide to back away from being such a large holder of U.S. Treasuries, they'll be able to do it with much more agility than if they held long maturity paper that they had to wait out to roll off of their own balance sheet, so to speak.
Okay, all right, fair enough. Well, so then going into the question of normalizing and trying to do the right thing, is that
Hmm.
even possible? I mean, we've already seen the Fed is backing away. If it's not possible, is there a soft landing in there somewhere? And if not, where does your Quill intelligence tell us this is all going?
It's interesting to hear the debate. I listen a lot to Bloomberg radio because they're more in-depth interviews, if you will. And this talk about engineering a soft landing, to me, it's fanciful at best. I don't see the Fed being able to accomplish this feat, mainly because every dollar of debt, every penny of money printing has produced a bigger and bigger and bigger debt pile. And that is, if you want to think about it, tinder that can start a fire. It's combustible. And what we discovered uh, in the post-Halloween era, when the debt of General Electric was downgraded on Halloween by Moody's, when 2 weeks later, because those bonds traded into junk territory, the new issuance of junk bonds completely shut down and stayed shuttered for 41 days. What we discovered, to answer your question, is that no, we cannot normalize the idea that interest rates rise to a certain threshold that's sufficient enough to shut down the bond market. Implies that Jay Powell's backed himself into the world's tightest corner. I shouldn't say Jay Powell. His predecessors certainly set the scenario, created this backdrop. But again, he wasn't able to get to his 3%. The most he was able to tighten was 4 times in 1 year. And I think most would agree that the December 2018 rate hike was a policy error at this juncture, which shows you how very fragile the U.S. economy is and how dependent it is upon cheap money.
Yeah, that's really interesting. And that brings to mind more of a psychological than an economic question. And if you don't have an answer to it, that's okay. But it really strikes me, the average person understands that you have to balance your checkbook. And you can't kite checks forever. And there's only so much you can charge up your credit cards before it really is a problem. And nobody questions that. Everybody understands it. By what magic transmutation does that same person think that that doesn't apply to a larger entity just because it's larger and it's called the government?
Well, again, we're falling back on two things: our reserve currency status and the fact that it has never failed. Money printing has yet to fail. It started the day after the stock market crash of 1987. It started in theory when Alan Greenspan started leaking information to bond trading desks ahead of Fed moves to inject liquidity into the system. That is the day that the Greenspan put was born. And every iteration that followed, whether it was the tequila crisis or Orange County or long-term capital management, every time the system was threatened, the Fed simply threw more ammunition at it, made policy that much easier for that much longer. And it really, if you look at a long-term chart of the S&P 500, it's been a little bloody along the way, but it has yet to fail.
Right. Well, that's really interesting. And I remember, in the crash of 2008 and looking at how bad it was and Lehman and everything and thinking, there's no way they're going to paper this over. Like, this is it. This is so big. This is going to be the time to pay the piper. And yet somehow they kicked the can down the road.
That was Bernanke's bazooka.
Yeah. So is that possible again? Like if Powell is painted into a quarter, courtesy in part by his predecessors, and push comes to shove again, I mean, it just seemed inconceivable that they could put off before, but the inconceivable happened. I'm asking you a crystal ball question, but what's your outlook on that?
It's very difficult to say what the interactivity is going to be between. It's not just the United States that's seen the tremendous buildup of debt. It's not isolated to subprime mortgages in U.S. residential real estate. It's now the fact that China's seen the fastest growth in their debt market. It's largely a black box in terms of its capacity to spread systemic risk throughout the global financial system. We simply don't know. Mario Draghi at the European Central Bank has taken interest rates into negative territory. God knows what could happen with the European Central Bank's balance sheet. So we don't know what the interconnectedness is going to look like when, as bond trading desks are already anticipating and talking about you can't listen to chatter unless you hear, well, the next QE is going to have to be at least 100 billion per month, and theoretically we can increase the Fed's balance sheet to 8 or 9 or 10 trillion dollars. These are the figures that are being bandied about under the assumption that it's going to work again.
Wow, that's really scary, and nobody really knows what the breaking point is. So,
No.
all right, but in terms of, I guess, why people feel justified in doing this, or why they feel safe to do this, I guess there's the experience, and it is hard to argue with experience. But there's also the apparent strength of the U.S. economy, the low record, decades low unemployment numbers. And I wondered, is that a mirage? Is that a Potemkin facade? Is that real? How real do you see the U.S. economy being, or this recovery?
I think some of it is real. I think a lot of it is engineered. I think Mother Nature played a role. People forget that in June of 2017, the big three automakers, and this is the largest sector of the U.S. manufacturing industry. I know people say we're a services-led economy, but if there's one thing that can drag you into recession, it is housing and autos together. So the reason I bring up this detail is because in June of 2017, the big three automakers had just announced major production cuts. By September of 2017, the automobile industry was in recession, and then Hurricane Harvey hit. And when Hurricane Harvey hit, it provided a genuine boost to economic growth because of all of the replacement construction and cars that had to be bought and replaced from those that had been flooded. Out of work Midwest construction workers simply up and relocated to Houston. A terrible oversupply issue in commercial real estate. Houston was ground zero, was absorbed overnight. And all of a sudden we had genuine economic growth. This was followed by two more hurricanes, major wildfires on the West Coast. Obviously, Trump had gotten into office. Next came the tax bill, which propped up stock buybacks that had already been running at record levels. You were able to give them some juice with repatriated money coming in because of the tax bill. The tax rate for corporations declined. They were able to start to push through some hiring increases while at the same time you have saber rattling. You have a tariff war that starts. You have truckers. You start to see the shortages. Our ports were completely overwhelmed, as were our railways, because so many U.S. corporations were panic buying in front of the potential implementation of tariffs that never came to be. All of this pulled the U.S. economy out of the slump that it was in. But the stock market had started to sniff out the fact that after the sugar high came and went, what were they going to do after as an encore to the trade war that wasn't meant to be, to the tax reform bill after the Democrats had taken the House in the midterm elections, and they came up with a nothing burger. Markets started to sell off dramatically. The European Central Bank stopped increasing their balance sheet. Markets melted in the worst fourth quarter since 1931, and that is what shut down the credit markets. That is what triggered the Powell pivot. We had mortgage rates, 30-year conventional, top out last year at 5.05%. That was enough to put housing into a meltdown stage. A few weeks ago, they hit a low of 4.06%. And the Chinese launched $868 billion worth of stimulus in the first quarter alone. And that liquidity was able to pull markets out of their tailspin. But the question remains, what is the fundamental economic outlook? And we've definitely seen firms increase layoffs for 8 months running. And we've seen the speed at which wages are growing come down from a 3.6% annualized rate last October to 3% as of March. So the economy itself is definitely slowing and relying almost 100% on the stock market holding things together and record buybacks continuing to facilitate this mirage of economic activity.
Well, I did want to ask you about the interaction between the U.S. and the global economy, but let me come back to that for just a second, because what you said about the stock market is, I think, particularly interesting. We're in the heart, really, of the earnings season for this quarter, which is one where it's expected to see the companies come off from the sugar high, from the tax stimulus, benefits such as they were last year. But so far, things don't seem to be, shaken up too much. Do you have an outlook on that? And does it even matter if this market is really responding to the Fed and the perception of easy money? Do fundamentals matter?
Well, fundamentals don't matter to the extent that lower mortgage rates can induce millennials off the sidelines. We've seen very strong new home sales. We've certainly not seen that with existing home sales because sellers are not able to bring their prices down the way they need to. But new home prices had to go down by 9.7% in 1 month. That was a big number in order to coincide with those falling mortgage rates. So there's 10% of the housing market that's improving and 90% that's not improving. But more to the point, if you look back in the history of the stock market, in 1968 and in 1999, the net worth of Americans was more tied to the stock market than it was to residential real estate. Today, those two prior historic records have been taken out. In other words, the U.S. economy keys off of where the stock market is to the greatest extent in the history of the country. So as long as you manage to manufacture record high asset prices, CFOs and CEOs who pay themselves based on those share prices are not going to push through with the layoffs that they thought that they were going to push through with at the end of last year. The latest Duke CFO survey pushed out the beginning of recession until 2020. Again, over $1 trillion of stimulus in a 3-month period of time globally will buy you not necessarily fundamental economic growth, but it'll buy you a lot of time.
Well, that is pretty scary when you think about it, because if your wealth is tied into real assets, at the end of the day, you still hold the asset. If your wealth is tied into some derivative on Wall Street and that goes south, the potential for dropping closer to zero is so much larger. That's pretty frightening.
And then at that point, not to add too fine a point, but at that point we'd have baby boomers fall back on the home equity that they've built up at just the wrong time. So this terrible undersupply problem that we've had with the lack of supply in housing, blah, 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 that would vanish overnight. And you would have baby boomers desperate to sell their McMansions in order to make up for what they've lost in the stock market and what they've taken, what's been taken away in their IRAs and 401ks. So you could have a perfect storm, demographically speaking, because going into the last crisis, going into 2007, 2008, baby boomers had the optionality to say, you know what, I'm going to stay in the workforce for another decade. I'm going to be able to continue holding and maintaining this home and paying the mortgage rate. But now they're pushing into their 70s, and that same optionality is not there for them. So the stakes are much higher for the next major correction in the stock market.
That's really interesting. And one of my great mentors, Doug Casey, is a big fan of looking at demographics and the importance of demographics. It's sort of the Wizard of Oz behind the scenes of so many things. And what you said just triggered another thought in me, about the millennials now being incented by lower prices. But I wonder if any amount of lower price will incent them in a certain degree. And I'm thinking more about the gig economy and sort of the whole outlook of the world that younger generations have. And to give credit where it's due, it was Peter Schiff, my fellow Puerto Rican here, who got me thinking about this. And, if you're in the sharing economy, do you even, or if you're couch surfing the world, do you even want to buy a house? And
well, that's the question.
Right?
I mean, you have
or
to.
Or a car,
I wrote
right?
a huge piece about this for my institutional subscribers a few weeks ago, and it addresses that question. The majority of baby boomers' homes are in the Midwest. They're in the Rust Belt. They're in places that millennials simply do not want to live. And by the same token, it's not just baby boomers who have put off retiring for a decade. It's millennials who've put off procreating for a decade as well. So they don't have, to use the word again, the optionality of saying, I want 4 kids and a white picket fence in the exurbs. There's not enough time. They're pushing into their 30s, so they'll have 1 or 2 children, and they've learned how to live in smaller homes. They have become dependent upon and enjoy culturally being close to the centers of big metro areas. And in many cases, you're going to have a supply demand disconnect between what the boomers need to sell and what the millennials are, even if they have the financial wherewithal, willing to buy.
Right. So that's very scary for housing. And then there's the auto side too. Like with so many people, like, I don't need to buy a car. Why pay $500 a month in a car payment when it's, maybe $100 a month in Ubers and bus fares or something. So, and you said,
second month of production.
Autos and housing, you put those two together, and that's pretty scary. But the other thing was, and this is what Peter put in my mind, was, well, if you are participating in the gig economy and your startup goes south or whatever, you no longer have a job, but you don't have a company that you worked for that you can file unemployment. So the low unemployment numbers may not reflect the reality of what people actually experience in the real world. The younger people, the young working people, when the economy goes up or down and impacts that economy, the gig economy.
Yeah, it's interesting you bring this up because last December, Moody's, John Lonsky, an economist over at Moody's, put out a report about this that suggested that jobless claims would be about a fifth higher, about 20% higher than they were, if people in this shadow economy, if you will, had an entity to which to file an unemployment claim. But it simply doesn't exist. And especially when you also think about the shift towards more part-time employees, even if they're working for large corporations, some of them don't have the ability to file for those initial jobless claims. And again, I'll go with Lonsky's number that we would be seeing initial jobless claims about 20% higher than what we're seeing today. So you can't compare prior cycles to the current cycle because of how much things changed and because of the revolution that we've seen and the disruption that we've seen out of Silicon Valley that has changed the way we live and operate.
Yeah, the world really has changed. I remember when the year 2000 arrived, we were supposed to have Jetsons flying cars and all this stuff. It was so disappointing. It just looked like a grungier version of the 90s. But now it's really happening, right? Things are really, even the flying cars are coming now. Okay.
I mean, quite constantly, literally. And I have found that using Lyft or Uber, whatever, I have found that is actually, I compare the cost of using that as opposed to driving my own vehicle based on how much work I can get done for that X number of dollars. And I don't think I'm alone in making those types of decisions. If I'm sitting in the backseat of a car on my laptop, that I'm productive as opposed to watching the road.
Sure.
So I can't
and if you're in New York or something, and the parking would be much more than.
I'm in New York all the time for media, and Lord knows I get more work done sitting in traffic than anywhere else.
All right, so let's go back to the question of putting this all in context of the global economy, which is another thing that has vastly accelerated, vastly deepened over the years. And Draghi is calling, is cutting the outlook for the ECB, and China has stimulated over there. But who are their customers? Their biggest customers aren't actually the U.S.; it's the Europeans. Right. So if your customers aren't buying, what does that do? Regardless of your stimulus, how do you see the let me rephrase that. We all know the global economy is interdependent. Are there any particular red flags that you think investors should watch for? Like, if this happens, head for the hills, or if this happens, it's time to pile in?
Well, I think we need to appreciate the extent to which the United States economy can decouple. It all comes down to, and I'm not being overly simplistic, I'm being serious as a heart attack here. It all comes down to the internal combustion engine. And the fact that Germany is the world's third largest exporter, every seventh job, 1, 2, 3, 4, 5, 6, seventh job in the economy depends on the manufacturing industry. And you cannot turn a tanker inside of a narrow canal quickly and convert the German auto industry to electronic vehicles. And I'm going into the weeds here, but that's actually what's happened. That is what has happened to the global economy. It is that the third largest exporting nation is not able to export as many cars to the largest buying country in the world, China, because China has incentivized with cash for clunkers type programs the shift to electronic vehicles and Chinese corporations that build them. So the question now becomes one of, can you pull the third largest economy in the world out of recession with Chinese stimulus that does not exactly apply to it? Because you're trying to put a square peg in a round hole. I'm writing about this very subject this week, and how important it is to try and pull the European economy out of the tailspin that it's in. Because if you don't, and it continues to weaken, then at some point you will take the United States down with it. And that's even as President Trump continues to threaten tariffs on European cars.
Well, you remind me of talking to Doug. It sounds so gloomy. But
well, I don't want to sound gloomy. I'm just saying that it's 90% of Germans are employed upon graduating. They've done something in their educational system. They never got rid of vocational training. They were able to constantly increase their manufacturing input to gross domestic product. You can't take that away from the Germans. It's an accomplishment on their part. But by the same token, now they're overly reliant on an industry that is, because of the demographic and cultural issues that the two of us just discussed, in addition to China moving to electric vehicles, you combine these two things and, despite Germany's strength, there might be a resetting, and that's simply part of life having business cycles.
Okay, so I'm not going to call you a perma bear, but I will invite you to say
because it's all about the liquidity. All right. As long as there's enough liquidity out there, the stock market's going to hang in there, even if fundamentally, economically speaking, it doesn't make sense.
Okay, so that brings up two separate questions then. One, is there a path out of the quagmire? I mean, it seems like everywhere we look, there's just another sucking swamp there. Is there solid ground somewhere we can get out? That's the sort of the big picture fundamental. The other one, though, is I guess just the stock market. If the likeliness is that we're still in the bad news is good news economy, and bad news means more stimulus, means more QE, and therefore the stocks go higher, then maybe as stock speculators, really, there are no investors today, we're all speculators, then maybe we have a great year despite how bad it is.
Yeah, I think it's a matter of when investors wake up to the fact that the Fed has embarked upon an easing cycle. And you can paint it any way you want, but easing cycles tend to coincide with, even if there's a lag, the beginning of recession. So I don't think that this is an infinity type situation. I think that if we do see the Fed continue to broadcast that it's going to put out an insurance rate cut. This is a first. They say it also happened in the 90s, but it wasn't quite the same situation. But if the Fed was to say, we're going to cut rates just in case, you could buy more time. You could buy more downside in Treasury rates, which would buy you more easing and more time. But just appreciate that when the Fed announced that it was going to slow the shrinkage of its balance sheet, that was the beginning of an easing cycle. Easing cycles coincide with recessions. CEOs, CFOs have not said that recession's not coming. They've just said that there's going to be more time than they'd anticipated before the onset of recession. But the yield curve did invert. We did not imagine that happening. So instead of talking about a 2019 event, we're talking about a 2020 event. The question is, when do markets decide to price it in? Are they going to give the Fed more leeway than usual because the Fed is trying to buy more time by being more aggressive than it ever has been?
That's very interesting. And I know the time frames are different from your time in the Fed and Greenspan's, but I just got to ask, did you ever meet him? Did you ever have time to talk with him and get a feel for his mind?
I've met Bernanke on several occasions, but I truly did come in the post Greenspan era. So I've never met Alan Greenspan. After writing the book, and I didn't write anything about him, I actually let the book write. They all said it in their own words. Alan Greenspan, Ben Bernanke, Janet Yellen, the entire book is written in their words. That's why there were 100 pages of endnotes. But I doubt that if he's read Fed Up, he would want to meet me. So,
well, I'm just curious because there was the day, many moons ago when he was a fan of Ayn Rand's and advocated for the gold standard. And I would love to talk to somebody who knows him well, who can tell me, what happened? Did the switch go off in his head, or was it all deliberate?
Just from what I've read and what I understand and actual transcripts, there are two pieces of the puzzle that you can put together when it comes to Alan Greenspan. One is very superficial, and that is that he really liked being popular. And this came out in his biography that was written by Sebastian Nality, which I recommend, because it really comes out that he knew that he was doing damage long term to the housing market. He understood what housing bubbles were, and he instead chose to take the easier path because it was fun to be a popular guy. I'm paraphrasing, but that's really what came out of his biography. And the other thing that came out, and my biggest defense of Alan Greenspan, is that and this came out in Paul Volcker's biography. There was a time years ago when Bernanke was ascending into power that there was a great debate at the Federal Open Market Committee about where the inflation rate should be. And Alan Greenspan basically said, I think zero's about right. Why would you peg inflation at 2%, which guarantees that you're going to cut people's money in half in 50 years? I don't understand the thinking behind it. Avoid setting a hard inflation target. It's going to be a slippery slope and we won't be able to escape it. And guess what? That's why we've had the current iteration of lower for the longest period of time. It's because the first thing Bernanke did was set that 2% inflation target. Janet Yellen was also a huge advocate of it. I take my hat off to Alan Greenspan publicly and say, thank you for trying to fight the good fight and trying to keep inflation exactly where households want it, which is zero.
That's
and
very
corporations
interesting.
for that matter.
Okay, well, you've been a very good sport. You've answered a lot of questions I had, but I want to wrap up the conversation with giving you the chance to hold the mic here and tell us, is there anything that you really think investors in general or people interested in finance should know and are not thinking about it? Like, not an agenda here, but there's so much chatter out there. There's so much noise, everybody trying to sound clever. What do you think is important that people who are concerned about the economy and finance really should be focused on?
Well, I think there really are two things at this juncture. I think you should listen to companies, and the biggest red flag that I think can be raised, and this is something you can hear through the noise, is if CFOs start to be focused on their balance sheets. That is code for we're going to stop doing share buybacks. And that is what happened at the end of last year, because if you're going to focus on cleaning up your balance sheet, then you're shifting you're shifting the interests away from those of the shareholders to those of the bondholders. And that is by its very definition unfriendly to the stock market. And that is what we saw at the end of last year. So listen to chatter about being overly indebted, looking to placate bondholders instead of shareholders. And then on a very micro level, I would suggest that you follow Ward's, or you can follow me on Twitter because I follow it very closely, but I would suggest that you follow Ward's and the trajectory of auto production cuts, because of the ability for this tiny little data point to have ripple effects throughout the U.S. economy. And if you need one leading indicator, if you're not going to read me on Quill Intelligence, if you use the macro of CFOs paying attention to their balance sheets and the micro of auto production cuts, you can pretty much paint a picture of where this economy is headed, and you'll be sniffing it out at the same time the stock market is.
Okay, well, thank you so much for your time and a very interesting conversation.
Thank you. Appreciate it.